Hi everyone. So today I have come up with a very interesting topic which is vital US recession, a reality check. So you must have been watching lot of videos in the YouTube or blogs in various channels and news wherein they are telling that US is at its verge of going bankrupt or it is going into a recession. You are going to have a big stock market crash and you will be losing your entire money, etc. So that's why I have come up with this video wherein we will be decoding lot many things. So to give a brief about this, I'll be discussing what is recession, why the US recession matters to us, what is the probable major causes of recession. We'll have a check on the economy of US in 2024. We'll be also analyzing the US debt bubble and its comparative study with India. Then we'll be looking into macro fundamentals like from whom the US actually borrows. Also, we'll be looking into why US is borrowing if it simply can print money. Then we'll be looking into the yield curve inversion. Then we'll be looking into this famous quantitative easing, quantitative tightening. Then US treasury buybacks are also analyzed in detail. Then we look at US debt ceiling, de-dollarization, then the US oil crisis. Also, you will study who is this US Federal Reserve and then why 2% inflation rate is the target for the Fed, why it is so. We'll also look into Silicon Valley bank collapse, Credit Suisse bank crisis. Also, we'll have a look into the Buffett indicator and how to get out of this debt crisis as far as US is concerned. And finally, as stock investors, as value investors, what we should do as far as our portfolio is concerned, including the stocks, mutual funds, or other assets are concerned. So if you see, there is a lot of content being power packed into this small video. So it has taken a lot of efforts for me to analyze all these macro fundamentals and also collecting data and investing time and then power packing that into this video wherein you will be benefited of all this analysis. So I humbly request you, if you like this video, you should share this video to your loved ones, your friend circle, your investor circle, so that they are also benefited from the data which is being shared here. So let's get directly into the topic. So what is a recession? So it's a significant decline in the economic activity spread across the economy which lasts for more than a few months, two consecutive quarters of decline in a country's real GDP, which is inflation adjusted and normally visible in production, employment, real income, and other indicators like sales, industrial production, etc. A recession begins when the economy reaches a peak of activity and ends when the economy reaches its trough, which is nothing but the downhill of the curve. So the question, why recession in US really matters? Because the US is the world's largest economy and has strong trade and financial linkages with many other economies. Most of these globally synchronized recession episodes also coincides with the US recession. So talking about the synchronized recession all over the world, in line with the US recession, you can take the mid 70s, mid 80s, early 90s, and early 2000s. So even during the COVID times of 2019 to 2020. So if you see, US, Japan, and Germany are as of now the largest economies as far as the GDP is concerned. So any disruptions, especially in US, completely sends a wave across the entire world, entire globe, and they also are stuck with that economic wave, whether it is recession or any other macro factors. Now that you have learned what is recession, why recession in US matters globally, then let's get into the causes of recession. So there are several number of causes, but briefly talking about, first is the sharp change in prices of the inputs used in producing goods and services. Say if the oil prices increases because of some reason, then the energy becomes expensive, then the overall price level increases and the aggregate demands goes down. So this can lead to a recession. The another case can be a country's decision to reduce inflation, say by employing contractionary monetary or fiscal policies. Example, a monetary policy wherein decline in goods and services happens. So this will lead to recession. The third thing can be a financial market problem. So sharp increase in asset prices, say stocks, real estate, and a speedy expansion of credit as a result of quantitative easing. This can lead to rapid accumulation of debt. Now, what is quantitative easing? We'll explain in detail in the coming portion of this video. So please be patient. So for this example of financial market problems, so as corporations and households get overextended and face difficulties in meeting their debt obligations, they reduce investment and consumption. So this will lead to decrease in economic activity. Not all such credit booms end up in recession, but when they do, these recessions are more costlier than others. Now, the fourth cause of recession which I have identified is recession can be a result of decline in external demand, especially in countries with strong export sectors. So what are the parameters by which the recession prediction is done? Is like asset prices, unemployment rate, interest rate, and the consumer confidence. So these are mainly the four factors by which we measure the recession or the extent of recession. Now let's get into the economy status check in 2024 for the US market. So as you know, more inflation means weakening economy. That's the concern of 2024 in US. Well, in that case, many other developed economies. So Jamie Dimon, the CEO of America's largest bank, JP Morgan. JP Morgan handles almost $2 trillion in deposits and its market cap is around $500 billion. So this is not a small bank, and whatever the CEO of this large bank tells has to be taken in a very serious way.
Consumers in pretty good shape right now. Unemployment's under 4%, has been there for 2 years. Housing prices are up, stock prices are up, jobs are plentiful, wages are finally going up at the low end. The consumer's in pretty good shape. The one thing you got to be cautious about, a lot of it is driven by just fiscal spending. So even today, the deficit is 6% of GDP, almost $2 trillion. That's driving a lot of this growth, and that will have other consequences possibly down the road, called inflation, which may not go away like people expect. So when I look at the range of possible outcomes, you can have that soft landing. I'm a little more worried that it may not be so soft and inflation may not quite go away people expect. I'm not talking about just this year, I'm talking about 25 and 26. The rates may have to go up a little higher. I'm talking about the 10-year rate, the 5-year rate, and that can have consequences. So we'll see. Briefly talking about what he has spoken in last year or this year regarding the US economy status can be divided into 5 major points. He says as US consumers are in good shape since economy is doing well, but also says that the US economy is doing well since US government is spending in the form of quantitative easing so much money to propel the economy. So much money is being spent means so much money is also borrowed as well, because they are not getting enough income through taxation, which is the revenue for the government. So more debt burden, inflation could be difficult to control. So the next question is, will there be a soft landing of the US economy? So that's the second point. So as per the market sentiment, the market thinks that 70 to 80% probability is there for a soft landing. But as per Jamie Dimon, he thinks that 35% of soft landing is the probability. Now the third point is, will interest rate go up or down? So as per Jamie, interest rate will go up from here. So due to high inflation, if you see, we have got sky high deficit by US government. Also, there is de-globalization and loss of energy infrastructure investment by US government. There is lack of productivity in the economy. Not enough GDP generation means not enough tax collection, which is the revenue for the government. So obviously the deficit has increased because he has to borrow more to spend in the economy to revive the economy. And also as I speak, the interest rate has gone to much high levels of 5.25 to 5.5%. So people are expecting a rate cut of 25 basis points or more than that to some 5.1% and later to 4.8%. So if you see the 5-year or 10-year treasury rates have gone up so high, if you see so many things are pegged to 10-year treasury rates. If 10 years treasury rates increase, the home loan interest rates will increase, the auto loan interest rates will increase, even your credit card interest rates will increase. So as per Jamie, he tells that the interest rates can go as high as 8%. Now the Fed chairman Jerome Powell is talking about interest cut in the coming months in this year. So we will have to see whether this is a reality or this is not going to happen. The fourth point is Bidenomics working? So what Jamie Dimon is telling is that yes, it is working, since he tells that the QE has propelled the economy, the quantitative easing has propelled the economy, not by the real economics productivity, but by the artificial injection. So it has made rich richer and not so rich poorer. So money printing activity gone terribly wrong, I guess. So Matthew Boss, the equity research analyst of JP Morgan, says that it's a selective recession. He tells that it is already started. So higher income consumer, like those with lot of wealth, so around $40 trillion, they are becoming rich and they don't have any problem. But the low income consumer, they're actually like a melting ice cube. And the fifth question, what Jamie Dimon was asked is Jerome Powell, chair of Federal Reserve, doing a good job? Fed was late in raising the interest rates is what he has told. So from this, it is very clear that US economy is not in a good shape. Now let's talk about US debt bubble. So whether it's a bubble or not, we will analyze after we list down all the facts about the debt of US. So as a fact check, interest rate is at 20 years high in US, and also it is not going down so soon. Stock market is going up and is kind of all-time high. Home prices are also going up, and also all the asset prices are surging up. But don't be swayed by this bubble. Fundamentals are not at all strong. So why it's not strong, that we'll discuss. If you see the federal public debt,
is as high as 34.89 trillion US dollar as I speak. So if you take a ratio of the total debt of the US government, which is 34.89 trillion US dollar, so that debt divided by the GDP of US, which is like 28.78 trillion dollar. The debt to GDP ratio currently as I speak is at 121%, which is nothing but 34.89 divided by 28.78. Anything above 80% is considered to be very high. If you see, the debt was only 23 trillion US dollar before the pandemic, the COVID, and now it is 34.89. So that's like a 50% increase from the pre-pandemic levels as far as the debt is concerned for the US government. So in just 4 years, the debt has increased by 50%. So basically, we measure a country's debt by its economic output. So economic output is nothing but the GDP. So that is the amount of goods and services provided each year by a country. So that is why we always compare a debt to GDP ratio. So debt is basically the amount of money government owes the public. So the public can be US natives, it can be various countries like China, Japan, or even India, and other debt holders. So if you see, the income for the government is the taxes from the economic output of the country, which is the GDP. So as the GDP increases, there will be more economic activity, there will be more profits or turnover, and there will be more taxation. And as the taxes increase, the revenue of the government increases. And if you see, the government has spending as well. So basically, using his revenue, he has to spend. So the spending includes those of schools, roads, infrastructure, military, social services, Medicare, Medikits, social securities, and even interest on debt. So what is this interest on debt? So as the revenue is less, basically the taxation revenue and some other revenues for the government is less, always the government has to take some debt so that he can service the spending, like what I mentioned above. So they take some debt and they have to repay the debt with interest. So they have to pay an interest as well. So the spending of the government also includes the infra and other stuff. Along with that, they have to repay the interest on the debt as well, which is also a burden. So if the debt is very high, the interest payment also is very high. So it's a vicious cycle. But if you spend much more than what you can earn, we have to borrow huge amount of debt. So that is what is happening in US. As you saw the figure, the US debt is skyrocketing. So how US got there? So mainly I can split that to 4 points. One is military spending. So Afghanistan, Iran wars, etc. They have spent a lot of money, including this Russia-Ukraine war. They have been spending money for reinforcing the army of Ukraine and all. So this is actually spending for him. Another is like 2008 financial crisis, wherein market crashed, people lost job. No job means less taxpayers. So again, lesser income, but the spending has to be done to revive the economy. Then again, more debt. Again, debt level raised. Third point is another spending program which came in 2017, Tax Cut and Jobs Act, which further cut the tax revenue. Again, forcing the government to take more debt. Now, the fourth point is that the pandemic hit in 2020, 2019, 2020, wherein US needed to borrow even more money to cover the COVID relief spending programs. The major spending is always obviously for US is for the military activities, but as you see, the debt interest payment has exceeded the military spending in 2024 as I speak, which is definitely so much alarming. So roughly speaking, US spends almost $6.71 trillion for the country as spending, and it collects tax of around $4.83 trillion. So the deficit, which is the difference between the tax collected, which is the revenue, minus the spending, is around $1.88 trillion. So how to fund this? So this definitely will be funded through debt only, by borrowing the money. Now again, talking about GDP, how it's computed. It's computed by the expenditure method. So four components of the GDP include consumption expenditure, so expenditure due to purchase of goods and services by us. Then second is investment. The private sector invests money from production of goods and services. Then the third is government expenditure, which is self-explanatory. And the fourth one is net exports, which is total exports minus the total imports of the country. So all these four things, by using the expenditure method, the GDP is derived. Now looking at India, so you know everything about US now. So now talking about India, India's economy is fundamentally very, very strong as I speak. The GDP of India is currently 4.1 trillion US dollar, and it can become 5 trillion in the coming years. Currently, it's at fifth position as far as the GDP positioning is concerned, and the third largest fintech economy in the whole world. Now, talking about the retail inflation. So, India's inflation is well within the limits of 4% to 4.6%. So now talking about another factor, which is poverty, it uplifted 24.8 crore people out of the multidimensional poverty since last 9 years. Now talking about the agriculture sector, which is very important for India. So it's robust for many years and it is performing well because of various government initiatives which has been introduced recently by the ruling government. Now talking about trades, especially the international trades. So the current account deficit narrowed over last many years due to increase in exports. This again contributes positively to the GDP. Now talking about government expenditure. So 11.11 lakh crores in 2024 budget was allocated, which is very high and very good and good for boosting the economy. So these expenditures are like infra boost, etc. Talking about COVID-19 recovery after the technical recession, which happens for like 3-4 months, which is the shortest in the complete history of the world. So which happened in 2020. After that, the country, it grew at 9.1 rate in 2021. So this is like a V-shaped recovery as far as the GDP growth is concerned. Now, what are the issues in India? So high level of unemployment, then poverty is high. The money is in a group of people, and there are a lot of poverty struck people. So they also has to be uplifted from tier 2, tier 3 cities. And also income and wealth inequality, which is very important to be discussed. Because of this, even though the GDP is like 4 trillion US dollar, the per capita GDP, which is the total GDP divided by the population of the country, which is very low, below 3. So if you see for China and all, that value is like 13.14, and if you see USA, it is 85.37, and if you see Germany, it is 54. UK, it is 51, but in India it is 2.73, which shows that the poverty is more in the country and the GDP contribution is only by the particular section of the population, and not everyone is contributing. So this income and wealth inequality needs to be mitigated by good policies by the government. Now the next session, from whom US borrow money from? Every time government want to borrow money, it doesn't turn to a bank unlike you and me. It goes to the public market to borrow money from the public. So who are the public? Those are the individuals, organization, and institutional investors. So this public choose to lend the government money by buying notes, treasuries, and bonds. Note, it is notes, treasuries, and bonds. This can be purchased from the banks, brokers, or the government itself. So these are promissory notes, which are otherwise called the bonds from the government, that it will pay you back that debt with an interest. That interest is called a yield. So basically a bond yield, also called coupon rates. So investors trust the US government due to its strong economy and believe or trust will never default. So even with a lower yield, they lend money for such small interest rates. So it's a way of getting little bit of money on your cash, kind of risk free. But as US debt increased, lenders lost confidence or will lose confidence, and will US government be able to pay back the debt? So this becomes a question for them. So investors will not be much interested to lend money to the government at lower yield. So government has to raise yield to higher rates to attract these investors. So if investors get higher yield, they buy those government bonds. So this increase in bond yield also will lead to higher interest rate for our personal loans as well. So interest can pile up and you just can't catch up and repay it. So this is what we are talking about the US government. So this can lead to a credit bubble. Again, talking about the overall economy of various countries or the GDP. For India, the public debt to GDP ratio is around 82.5% as I speak in 2024. GDP of USA is the highest and it is like 28.7 trillion US dollar. China is 18.5 trillion US dollar. Germany is 4.5. Japan is 4.1. India is around 3.9 to 4 trillion US dollar. And UK is 3.5. So India is at its verge to overtake Japan and then Germany to reach and become the third largest economy as far as GDP value is concerned. But as I told, the per capita GDP of India is very low as 2.73. It is basically a measure of country's economic output per person by dividing the total GDP by its total population. So basically, it is utilized to measure a country's prosperity based on its economic growth. So as I speak, already UK and Japan is in technical recession. So this recession in UK and Japan will definitely impact other countries like India as well, because there will be global demand contraction, less import export. The remittance will also go down. In 2023, it was 123 billion US dollar in India, and also the remittance will go down based on this recession, global recession, because the money which is sent by the our people who are working outside to India. This is called remittance. So this was $123 billion in 2023 to India. This will also go down, impacting the economy, and also the flow of investments through FDI, FPI, and FII also to India reduces because they are in a fix, so they don't have liquidity. So no liquidity means no investments to India. So we will not be shielded from this recession if recession happens in big economies like UK, Japan, Germany, and USA. So that is the impact. So it will definitely impact our economy as well, and also our stock market. Now the other session. Why does government, that is the US government, borrow money if it simply can print money? Before getting into that, let us discuss what is printing money. So Federal Reserve prints money, not the US government. So Fed prints money and Fed lends money to bank, and bank lends it to the government. So when the money printing is done, it takes away the buying power of one or the other who holds the US dollar, because more money means more supply of US dollar, so the demand goes down and the value of the currency goes down, so the buying power also goes down. Basically it's a concept of demand supply. Now what is the income for the government? So major is the taxes, other is to the borrowing by using bonds, the treasury bills, which we call as T-bills. And the third one is printing money. But the only difference between the taxes and borrowing versus the money printing is that in taxes and borrowing, the buying power is constant or fixed and not changed, as the money you paid as tax is unavailable to you. But government gets it to buy something with it. So buying power in economy is fixed. So is for borrowing. But for money printing, you gave your money and the government gets new print money to buy more. So there is more money in the economy, and hence the prices of goods and services increases and it causes inflation. But for money printing, you have your existing money and the government gets newly print money to buy more, so that there is more money in the economy, and hence the prices of goods and services increases and it causes inflation, because as more money is available, people can buy more, and this will lead to more demand of goods and services, and hence the price of goods and services increases, which is nothing but inflation. So this inflationary financing will disrupt the economy, especially the labor class workers and middle class. During COVID times, $5 trillion injection just by quantitative easing was done by the US government, which led to increased inflation due to liquidity and more spending. So to cut down the inflation, the Fed increased the interest rates. Problem with inflation is that it compounds earlier inflation with the current inflation, and this compounding will lead to high levels of inflation. So the Fed target of inflation is 2%. So why not 0% or why not minus 3%, which is basically deflation, to bring down the prices of the goods? So the Fed or the central government don't want deflation because US government have huge debt. So this debt is the borrowed money by the US government from the US residents, even it can be you, me, and other countries, and also the Federal Reserve. Like we buy the treasury bills, T-bills from Fed by paying them the money in return for a fixed coupon rate for a duration. So if you see, trillions of dollars is also borrowed from the Fed as well, who doesn't actually have money but can only print money. So US government have to pay back the $35 trillion debt along with the interest. If you see, inflation makes the dollar value tomorrow less compared to today. I mean, the dollar 10 years back is much valuable than dollar today. So with higher inflation, they want to pay back the debt. They means the Fed, by using cheaper dollar. So with inflation, more spending by people, more tax collection, more income for the US government, and less debt borrowing expenses. So the gist here is that if the income is less, which is basically from taxes and other sources, the government will have to borrow more money to pay the debt interest. So it's like using your Visa credit card to pay your MasterCard credit card. So this is a huge problem. Thus, money printing is not that much desirable. So you will see other ways by which you can bring down inflation and bring in the economic balance, economic activity back to order. And the last thing is only money printing. Now the important concept of yield curve inversion. So what is a yield curve inversion? It is a graph depicting the relation between the short term and long term interest of the treasury notes. Treasury notes is nothing but the T-bills or whatever you call as treasury bills, treasury bonds, all are the same. So basically these are bonds by the government bonds. Usually the short term interest rate is lower compared to the longer term interest rate. Since longer term has more risk and more inflation factors, so demands for higher yield by whoever is buying that bond. So risk is like high chances of default, etc. in a longer term compared to a shorter term, higher visibility. And also inflation is like higher chances for the change in the cost of living, etc. This can also be uncertainty for the bond yield in a longer term. So on the screen, whatever you see, that's a normal yield curve. Now sometimes there can be flattening of yield curve, means the short term and the long term yields almost become the same. Now let us discuss about yield curve inversion. The yield curve inversion is like the short term bonds interest rate become higher compared to the long term yield. So why this happens? Because investors think that in longer term there are a lot of uncertainties, there is a lot of debt by the government, there can be chances of default, and there are a lot of issues. So the economy is not growing well. So they think that in a longer term there are a lot of risk. In shorter term, at least I have visibility. Shorter term bonds are valued more by the investors compared to the longer term. So in that case, the yield curve inversion happens, where in the shorter term bonds yield increases compared to the longer term. So every time the yield curve gets inverted, basically the 10-year yield curve, the economy has gone to recession in the past. So when short-term interest rates are higher than the long-term interest rates, investors are anticipating the economy to be weaker in future. Normally it takes 2 years after interest rate hikes to impact the economy with larger effect. So currently as we speak, the Fed is having the highest interest rate of 5.5%, and the impact of that is not yet seen in the economy. The inflation is still at a higher levels. That is why I'm telling that it takes a longer period for the impact of that to be reflecting in the economy. Now another hot topic, I have been speaking about quantitative easing. So what is quantitative easing? So quantitative easing is one of the monetary policy in which a country's central bank, say US Federal Reserve, purchases securities in the open market to reduce interest rates and increase the money supply. So securities are like bonds. So they buy the bonds, in return they pay the cash, and they inject liquidity into the market, and basically it increases the money supply into the economy. And quantitative tightening, if you see, it is selling the bonds and getting cash back, which reduces the liquidity in the market. So the buying power goes down. Again, quantitative easing is basically bond buying, I can say. They buy bonds and inject money. So increasing the money supply in the market pushes the economic activity up. This is a kind of economic manipulation and not real growth of economy. Basically, no real productivity. With QE, the central bank purchases government bonds and other financial instruments such as mortgage-backed securities (MBS). So QE is normally implemented when interest rates are very low. In US, it was near zero, and economy is weak. So when economy is weak and the interest rate has already touched its lowest, which is zero, then only the QE is done. Because as I told, money printing is dangerous. The interest rate has hit low and the economy is so weak, so government has no other way but just to print money, basically the central bank. To execute QE, central bank buy bonds and other securities, injecting back reserves into the economy through other banks, and banks gets liquidity and then lends to the other borrowers. So it can be government, it can be the public. This increased money supply of money provides liquidity to the banking system and lowers interest rates further. This allows banks to lend with easier terms, because if the interest rate is low, there will be more borrowers and there will be more lending done, and it will again inject lots of liquidity into the economy and more spending. So government may implement fiscal policies as well to expand this money supply. So what is a fiscal policy? It's the use of government spending and tax policies to influence economic conditions, and it's done by the elected government officials. So basically this is a capital expenditure by the government. So this will actually influence the economic condition, especially the macroeconomic conditions. One example is, while inflation, government would cut spending to cool down the economy, and conversely while recession, increasing spending to encourage demand and to push the economic activity upwards. While the Federal Reserve can influence the supply of money in the economy, the US Treasury Department can create new money and implement new tax policies with the fiscal policy, thus sends money directly or indirectly into the economy. Hence, QE can involve a combination of both central bank's monetary policy and the US government or the particular country's government's fiscal policy. Now let's talk about the US debt ceiling. Money is required for reviving the economy. That is very clear. So you can limit the debt till a particular limit, which is called the debt ceiling. If you hit it and need to cross it, permission is required. Congress has revised the debt ceiling 78 times since 1960. That is a whopping 78 times. You heard it right. So during Obama presidency, the largest debt was taken, which was 7.6 trillion US dollar of debt. Trump has taken 6.7 trillion US dollar, and Biden in the first year itself had taken 2.5 trillion US dollar. So America has the ability to borrow unlimited money, unlike other economies. So since US dollar is the world's reserve currency, so USD has been a stable currency. So USD is used in world trade. Central banks keep their forex reserves mainly in USD, and the USD's perceived value is much more than a piece of paper. So because of this, there is a unlimited borrowing capability for America. So in 1973, what happened in Saudi? There was a petrodollar concept. So Saudi deal with US. So refer the video which I had done wherein I had mentioned about the petrodollar concept, which made US dollar the world's major currency. So if you have not seen that, do watch that. Now Saudi sells crude oil in USD. So USD is given back to USA by buying treasury bonds from US by Saudi. So this was the deal at that time. In return, US had promised to safeguard the oil drilling or crude oil extraction places and refineries by its military. Now 25% of US debt is held by other countries. Japan is the largest holder, then comes China. India holds a small portion of the debt as well. Whereas 75% of the debt is held by US public and other portion by the Federal Reserve, the central bank. So as I told, the trust on USA was lost and the AAA rating was downgraded to AA rating. So at that time, the stock market had taken a hit of 20%. During COVID times, the QE was done by USA. Almost $3 trillion of money was injected. It was printed and injected in a day. Budget deficit in 2019 was 4.6% of GDP. 2020 was 15% of GDP. And 2021, it is 16.7% of GDP. So you can see a fast growth in the budget deficit. Not talking about de-dollarization. Everybody is talking about de-dollarization. So it is a process which involves reducing the US dollar dominance in global market by substituting it as the primary currency for various financial transactions worldwide. So emergence of BRICS, then the Russia, China's strategic, especially after the undue advantage of US through its sanctions of facing the transactions in dollar. So this has emerged a lot. Arab countries also stopped the petrodollar deal in this year only and is moving on to other currencies and deals with China and Russia, etc. So crude oil is something very important, and if that trades also is getting converted from US dollar to other currencies, it's going to be a major threat for the US dollar and the US economy. So all these things will lead to lesser use of dollar for world trades, and this can actually degrade the power of US economy or the US officials. So this can again downgrade the economic rating of USA and again its political and economic power as a world's largest economy. We also need to know who is the Federal Reserve, the US Federal Reserve. So Federal Reserve is a bank of banks, I can say. Just like the Central Bank of India, it's a central bank of USA. So Federal Reserve was formed in 1913, but why was Fed formed? After the panic of 1907, the bank run, they decided it's not the way to run the economy. Then earlier, there were many Federal Reserve banks set up with respective presidents for each bank to take care of various regions of the US where the respective banks are located, and they set their own interest rates and policies. Then the Great Depression hit. In 1935, Congress put the Washington-based group of governors in charge. Group of 7 people from different parts of the country, including a chairman, which is called the Fed chair, each nominated by the president and confirmed by the Senate. They oversee the Federal Reserve System. So there are 7 delegates and there is a chair, and currently as we speak the chair is Jerome Powell. They also serve on the Federal Open Market Committee, FOMC. FOMC, which also includes 5 presidents, one from New York, and rest of them keeps rotating. And Fed meeting meaning making of FOMC, the Federal Open Market Committee. So Fed, as we know now, is responsible for interest rate control, check cashing, currency in circulation, lender of last resort, controlling the inflation, which is basically stabilizing the prices, giving out maximum employment for economic growth, also oversights the economy, then a banking regulator as well, not to mention. Fed's balance sheets include basically what Fed has as an asset. So basically it's securities held outright, the US Treasury securities, which is basically 2/3 of the holdings of Fed, and rest 1/3 is mortgage-backed securities, MBS. So this US Treasury securities, which is 2/3 of the balance sheet of Fed, includes short-term T-bills, notes, and bonds. Note that the money that the commercial banks holds at the Fed is not an asset but a liability which is not included in the above balance sheet of Fed. So Fed is so powerful politically and economically, and their decisions can actually impact the US economy. And as US economy, as I told, is connected to all the economies worldwide, their commentary, their economic actions, monetary policy, everything is looked over by the entire world. And any small wrong comment also by the Fed chair can make the markets fall and go up in no time, as you have seen in the past as well. Now, why this 2% inflation rate target by Fed? So 2% is a positive number, first thing. So easier to measure, unlike negative value. Another thing is that positive figure of 2% doesn't quickly slip to the risk of deflation. So deflation is not at all good for the economy. So hence the 2%. Now the third important thing is that 2% gives room for Fed to cut more interest rates. So if you see the interest rates minus the inflation gives us the real interest rate. But if you want to further lower the interest rate to push the economy, that is lower cost of borrowing of loans means more spending. So it pushes the economy. The Fed will have to stop as the interest rate is zero already. So zero interest rate means real inflation is 0 minus 2, that is minus 2. But if you want to push the economy back to full employment, then they have to stop as they have hit the lowest interest rate, that is 0. So then the only way is, as I mentioned, quantitative easing. So in quantitative easing, more money chasing same amount of goods means prices go up and high inflation. And that is without real productivity. So no more tax collection, less revenue for the government, again more debt for the government. So debt level is now all-time high. The Fed can increase interest rate to control the inflation effectively. If you see, this worked well back in 1920 under Fed chairman Paul Walker, because the total debt to GDP was low. That is like $914 billion was the debt at that time, and $2860 billion was the GDP of US at that time. So this works out to be 32% debt to GDP ratio. And currently, as we speak, it is 121%. So 32 is nowhere near 121%. So the interest rate could be increased to an eye-watering 18% to arrest the inflation, which had risen to 14.8%. So this begins to backfire when debt to GDP is too high. This is called debt paradox. When the debt levels get too high, anything the Fed does makes it worse. If they lower the rates and print more, the already high fiscal deficit means the money they print flows into the real economy and causes inflation. As the interest rates are less, people borrow money and spend more, causing inflation. So this will further rise the government spending as the cost of social security, public works, and military rises. To fund this spending, the treasury borrows more. Because of that, the debt further increases. Other way is to increase the interest rates. This lowers inflation. As the cost of borrowing increases, the people spend less and the inflation comes down. But as the debt level is historically high, the interest expenses, the payment on debt on the borrowed money for the government also explodes if they increase the interest rate beyond some point, which is currently happening. The interest rate is at all-time high, and also the debt levels are also at all-time high because the debt payments as interest is going very high, even more than their defense spending. So the main tool they use to control inflation, which is the interest rate, is going to cause the inflation. This is a devastating situation. So in longer run, the US debt skyrockets. So I explained you in yield curve inversion. To pay long-term debt, they are borrowing at higher rates in short term and refinancing it. In 2024 till now, around $8 trillion is refinanced, and this is further increasing the debt interest payment load for the US government. So the above long-term debt closure includes the interest plus principal, not to mention. Projections say $37 trillion will be the debt by the end of 2024 and around $40 trillion by 2025 end from the current $35 trillion debt levels. Earlier, since 2008 crisis till 2017, other countries have been holding the debt in the form of treasury bonds for the US, these China, Japan, and other countries. But since COVID pandemic, they are only borrowing a fraction of the earlier debt bonds, and hence the Fed has to hold the large portion of the debt compared to all other countries' central bank. Fed has to take it as retail investors are unable to borrow and banks already were stuffed with treasury bonds. Commercial banks buys bonds from the Fed and then lends them to the public. But as long-term bonds become low yielding and hence less liquid, to create liquidity in the economy, and for these banks, Fed is purchasing these long-term low yield bonds and servicing it with short-term high interest bonds borrowing, as I mentioned earlier. This was vital since banks like Silicon Valley Bank, Credit Suisse Bank all broke due to this liquidity issue. So Fed came up with funding as an alternative to quantitative easing is through bank term funding program, which is BTFP, allowing banks to borrow the bonds at its face value instead of the market price, allowing them to not realize any losses against the securities. This program is already at its peak of $167 billion. Another program of quietly injecting liquidity is drawing down the reverse repo facility. Banks and money market funds can deposit the funds and receive short-term overnight loans to satisfy collateral and legal requirements. In 2022, over $2.5 trillion was parked here, and these funds are with Fed. You should note. Also note that the Fed uses these funds to inject liquidity back to the market by re-entering it back into the market. So Fed is publicly trimming its balance sheet to improve liquidity as well by selling short-term bonds with higher rates and keeping long-term bonds which are having lower interest, which creates liquidity for banks, which in turn injects money into the economy. Fed is stuffed with lots of long-term bonds by selling short-term bonds so that the banks are freed up with liquidity of the long-term bonds, especially after COVID. This swapping is normally done by the poor third world countries who wants to attract borrowers as the country rating is less. But now US is also adopting this as well, since the US credit rating also has dropped from AAA to AA. And this buys more time and stop banks from blowing off. More money fixed up the banks and they can hedge this money in other parts of their portfolio, thus stabilizing the situation temporarily. Now, if you see the Silicon Valley Bank collapse and also the Credit Suisse crisis, all these were because of this illiquidity. So if you see the Silicon Valley Bank collapse in a quick glance, this was basically the crash of the private capitalist system. Silicon Valley Bank was the second largest collapse of bank in USA. Banks uses other people's money to make debt and profit that by lending them out. That's how basically capitalism works. Before the collapse in California, many lost job and then bank deposits were shrinking. Banks held government bonds as the interest rates went down to stimulate back the economy for more spending and revive economy. The value of the bonds went down, so the money which they have in the form of bond, which whose value was diminishing, to give back the deposits if the depositors wanted, and the decreasing deposits. So the regulators and the government didn't sense it earlier and let it break down. So this was kind of a bank run, and this led to the complete collapse of the Silicon Valley Bank. Now talking about the Credit Suisse crisis. Credit Suisse was the largest bank in the world, and this was a Swiss bank. So there was a lot of holdings from US as well in this bank. So the Credit Suisse crisis happens after the Silicon Valley and the Signature Bank crisis in US. After its peak share price in 2007, in 2023 it lost almost 99% of its share value to just zero point 0.6 Swiss franc and had $1.4 trillion in deposits, unlike the Silicon Valley Bank or Signature banks, which had lower deposits. The main issue, quickly as I speak, was there was a lot of litigations for the bank. So billions of dollars were spent for litigation provision as well, like case filing, court costs, arbitration fees, attorney fee, etc. So much money was spent for that. So the Credit Suisse was fined $2.6 billion, and as they pleaded guilty for helping Americans evade tax for decades. So this happened in 2014, and in 2017, Credit Suisse misled investors in residential mortgage-backed securities. It sold in run-up to the 2008 financial crisis. And in 2019, Credit Suisse was again caught in a corporate espionage scandal. A group of executives were later found to have ordered private detectives to track two outgoing executives. So all these issues. Then later, Credit Suisse reported a 5.5 billion loss on the collapse of US hedge fund Archegos Capital, which it was funding. And in 2021, finally, after the collapse of Greensill Bank, as they lend their bonds claiming it's risk-free to its investors, the Credit Suisse has to give away $10 billion of investor funds on account of this bank crisis. And after this, the rich depositors got frustrated and started withdrawing the funds, all of it in the year 2022. 37% of the asset management being the largest revenue generator, they saw almost 27% drop in it from 70 billion Swiss franc to 50 billion Swiss franc within a year from 2021 to 2022. This all came up with the Silicon Valley Bank failure also parallelly going on, and the credit default swap had skyrocketed for the Credit Suisse Bank as well. As Credit Suisse Bank is critical part of the economy, to avoid a collapse, Swiss central bank gave a $54 billion bailout to Credit Suisse to avoid its collapse for liquidity and avoiding default. Later, UBS, another bigger bank in Europe, took over this bank at a very low valuation. Even after its 99% fall, a per share value of 0.76 Swiss franc was given out by the UBS bank, and with a simple valuation of $3 billion, valuation, this UBS had bought Credit Suisse. So this is how the illiquidity and the economic problems actually can trigger the crash of various banks, including such huge banks. So nobody is protected from such economic crisis. So even more economic crisis can happen if such big banks are crashing, and nobody can bail it out as the money levels are so huge. If you see, around 1.2 trillion dollar is the yearly debt payment just for interest payment, and next year it is projected to be around 1.7 trillion US dollar, since they have to borrow new debt to pay off that debt interest as well. So currently, as I speak, about 4.83 trillion US dollar is the tax income, is the revenue for the government. So eventually, at some point, this tax income will equal to the debt interest rate alone. This will lead to non-affordability of debt payment, and this will lead to the great default by the US government. Then US government in this case goes for a deleveraging. Now, if you see, US uses inflation to erase its debt burden. Federal Reserve has got a balance sheet of around 7.35 trillion US dollar in the form of treasury bonds, etc. So what Fed does, it buys the debt from the US government and reduces the debt of the US government, thus sucking the liquidity out of the market, kind of quantitative tightening. And then again, they start doing quantitative easing, that is new dollar printing, interest rate will be high. Then again starts doing quantitative easing, then it implies new dollar printing, higher inflation rates, which again leads to higher GDP as well, ideally. And then prices increases, then the salary increases, then salary increases means more tax revenue, then this more tax revenue to the US government means more debt repayment. So they can cut the debt burden like this in an ideal situation, but currently this is not what is happening, because the monetary policies and the interest rate decisions has been way out of the path, and it has led to the complete crisis. As we have already spoken about quantitative easing QE, the Fed also has alternatives to QE for printing money. So this is like they're injecting liquidity into the economy in a stealth mode, in a secretive way. How are they doing that? One is they are buying back the US treasury bonds or treasury bills. So this is already discussed in detail. So they are actually buying the illiquid, low yielding long term bonds. So how are they financing it? They are servicing it by selling short term, high yielding bonds or T bills. So second way of doing this is rule changes for bank leverage regulation. So if you see, the amount of T-bills a bank can hold in its balance sheet is purely based on the strict rules imposed on the bank. They have to look at the assets and liabilities, and they cannot buy T-bills beyond a point. But with Fed bringing in a latest rule that banks don't have to look into the count of the treasury bills, but just other assets only. So basically the banks are enabled to hold as many treasury bills as they could, hence unlimited money printing into the economy. Also, the banks don't have to be worried about the risk, as programs like BTFE allows banks to offload treasuries to the Fed in case of a crisis. Also, they have discount windows available. Also, they have repo facility, that is lending at a lower rate overnight from the Fed, which again increases the liquidity for the banks for lending purposes. This is how the possible risk for the bank is covered by the Fed by the above points as I discussed. But now the main risk is that the world is dumping the US T-bills, basically the treasury bonds. So because of sanctions and other geopolitical issues, and also the de-dollarization initiatives, bigger countries like China and all has started utilizing their own currency for world trades, and this has led to lesser demand for US dollar, and hence the many of the countries in the world are dumping the US T-bills. Also, if interest rates spikes up further, these T-bills become illiquid due to dip in the value. So these are again big risks, wherein we have seen bank crashes like the Silicon Valley Bank and Credit Suisse. Typical examples. Now, one of the parameter, Buffett indicator, the Warren Buffett indicator. Basically, it's a stock market overvaluation indicator. It is a ratio of the total market capitalization of that country divided by the GDP of that country. So if you multiply it by 100, you will get it in percentage. So if you add the NSE and BSE stocks, market cap, it is something around 5 trillion US dollar. If you consider the GDP of around 3.942 trillion dollar, so this is around 126.8%. But in case of USA, a 54 trillion US dollar is the total stock portfolio, the stock market capitalization basically, divided by 28.783 trillion US dollar, which is the GDP, into 100 gives you 187.6%, which is like 48% more than India. So clearly this is a case of overvaluation of market cap. Basically the stocks are so much overvalued, and it is really due for a good amount of correction. So the most important and the second last session of this video, which is the conclusion. Finally, if I connect the dots, as I told you, US is the largest economy, very well connected to all smaller and larger economies. So any fall in the US economy or any recession in that will definitely impact all the global economies, including India, no doubt. US economy is, as per the detailed analysis which I have presented before you in this video, US economy is not at all in a good shape. The latest speech by Fed Chairman Jerome Powell also indicates that there is a high level of unemployment rate, basically joblessness, and still fairly high inflation, though he has told that there is a small dip in the inflation, which is just a consoling word for cooling down the investor emotions or the public emotions. Added by slow economic growth due to low productivity and lack of real growth. So this high level of unemployment rate, slow growth and high inflation has led to something called stagflation, which is detailed out in my earlier video. It is a classic case of monetary policy of Fed going terribly wrong. Yield curve already inverted since July 2022. If you see in July 2022, the 2-year treasury yield first exceeded that of 10-year treasury yield. And in late October 2022, the 3 months treasury bills also, the yield of that moved above the 10-year treasury note. So this is a typical case of a thorough yield curve inversion. Now it is like almost 24 months from the first yield curve inversion of this series. So normally if you see from 6 to 24 months after the yield curve inversion, recession has always happened in US. Also quantitative easing has been much high, reduced real productivity, and it has led to a credit bubble with large debt burden on US and continued breaking of the debt ceiling with debt interest payment exceeding first time the defense spending as well for the US in 2024, which is really alarming. The interest expenses incurred from around $34.89 trillion national debt for US totaled about $440 billion in the first 6 months of financial year 2024, an increase of $133 billion or else a 43% increase from the first half of FY 2023. Temporary band-aid patch-ups by Fed like US Treasury buyback, rule changes for the banks for T-bill holding is not helping the US economy in a long term in a meaningful way. Already big banks like Silicon Valley Bank, Signature Bank, Credit Suisse Bank, etc. are broken due to the above issues. Buffett indicator also has skyrocketed for USA and it is really alarming, all leading to a complete meltdown of the economy. So all these data points really indicates that asset prices, including that of stock prices, is going to crash and probably post elections, say in the month of December 2024 or maybe early 2025 can be an ideal situation for a recession strike in US. I am no one to predict this, but all this economic data really depicts the scenario for a clear case of recession in US. Now the final part, what should we investors do as we are anticipating a probable recession, a market meltdown, a stock market crash? What we investors should do? So if you see, before telling that, you talk about Warren Buffett's Berkshire Hathaway. They are now sitting at a all-time high cash pile of around 189 billion US dollar. So which is so huge. Buffett tells that this is because he didn't find a particular value stock or a particular attractive stock for which he can invest in. That is why he is remaining on cash, and once he finds a suitable opportunity, he will invest. But if you see, really, if you see, they have been selling part of Apple stocks and other stocks and remaining in cash, which can be a probable indication that he is waiting for a probable crash and after which he will invest. And also he is known for a value buying, wherein if there is a big crash, fundamentally strong companies, if they fall beyond their fair value, he invests in that. So that is a basic trait of value investor. And in our YouTube channel also, I have been administering the similar principles of value investing, wherein buying fundamental companies at a cheaper valuation so that you always have a margin of safety and you are safeguarded from bigger crashes or bigger portfolio meltdown. Now you already know, while we pick our stocks, the price to book value should be very low, 0.8 to 3, then maximum 5, then price to earning should be less than 15, maximum 20, EV to EBITDA should be less than 10, then they should have a good cash pile or cash equivalents in their books, then they should have good free cash flow, then low debt to equity, so that the debt is low means they don't have to bother about higher interest rates and higher debt payments, and if interest rates shoots up to arrest the inflation, if the RBI increases the interest rate also, this debt burden will not impact the profitability of the company. So things like this is very important, and also a good return ratios like ROE, ROC, ROA, all these things are important to be evaluated while buying into a stock. And also if you are holding the stocks for a very long time, then by this time the market is at all-time high, probably your stock may also be at all-time high. And if in that case, if the valuations are very high, if the fundamentals are not supporting that particular stock, and maybe the earnings are less, then the price to earnings are larger and price to even book is also larger. So this may be a time wherein you can partially book some profit, be in cash. I'm not telling you to sell the entire portfolio, but a small part of it, so that you have enough liquidity to invest in probably undervalued stocks when the probable crash comes in. And also I can see few stocks which are still undervalued, maybe they are still at 3-year low or something, or maybe a 52-week low. So if the fundamentals are good, then you can consider investing in them as well partially. I have been continuously posting various fundamentally strong stocks and their updates in my YouTube community post. So if you have been following that, you must be knowing the names as well. This is no recommendation, but my own views I am sharing there. Also, in such cases, diversification is important so that you can consider investing some part of it in commercial real estate spaces, especially fractional real estate investing, wherein companies like Strata is available. Now, the new SEBI rules are also bringing in SM REITs. About SM REITs, I've already explained in my earlier video. You can go watch it. Also, investing in REITs, InvITs is also good enough at this point of time. And also, obviously, stocks, mutual funds, you can keep going, keep doing your SIP in your mutual funds. But it is also important that yearly or twice in a year or in 2 years, you have to reevaluate your portfolio, your mutual fund performance, not based on rank, but based on the portfolio they hold. You have to see if there is any portfolio overlap. Then you have to accordingly adjust the mutual fund SIPs. Maybe stop one particular SIP, then start it in another good stock holding or portfolio holding mutual fund. So this continuous evaluation or active participation is also important if you want to beat the market. And obviously, remaining in cash at least 10 to 15% of your portfolio also will help you in investing at a cheaper valuation in your fundamentally strong companies. Even the companies which you hold in your portfolio, if it has gone very low due to the external factors like this US recession and all going forward, then you can consider averaging the price of that particular stock, so that once the crash is over, because this is not going to remain there for a very long time. Obviously, there is a lot of mutual fund participation, retail participation, and also a lot of foreign money flowing into India because of this better positioning of India in a worldwide economy basis. And also, we are a growing economy, and with a lot of initiatives by the Indian government and along with RBI and other monetary policy supporting the same, we are poised to go much beyond in the next 10 years, wherein we will be growing from a developing economy to kind of a developed economy. So next 10 years is the time for we retail investors to make good amount of money in stock market. But you have to invest your money intelligently and also buy stocks at cheaper valuation. As I always tell, price is what you pay and value is what you get. So hope this session has been really informative and knowledgeable to you, and you take away a lot of macroeconomic understanding concepts and what all probable decisions you have to take going forward in case of a market meltdown. I hope I have been able to deliver it to you. Though this has been a bigger video, I had to include each and every point so that you understand end to end about the complete scenario. See you in next video. Till then, happy investing.